It will give you the fullest understanding of how to do associates adjustments. Because your exam questions, they all have a subsidiary, maybe a joint venture, and an associate. So you should actually know how to make those adjustments when they are required. So the question reads, Cambodia Public Limited Company operates in the manufacturing sector. The draft statement of financial position at 31st December 2019 as follows. So you have Cambodia, you have Tukuta there, you have the assets, the current assets, total assets, equity and liabilities. Under equity and liabilities, my area of interest is what is on the subsidiary. It shows 1,000 or 1 million. Then the retained earnings is 800,000, which is actually tied to the investments here under Cambodia. Meaning that these investments which can be made were obviously coming from the subsidiary. That's the first thing, for sure. Secondly, there's a possibility, depending on what we're going to see in the case study, there's a possibility that there was a component which could have actually been attributable to the associate. So let's see what is actually in the question or in the case study. So it says the following information is relevant to the preparation of the group financial statement. On 1st January 2018, Cambodia acquired 70% of the equity interest of Tukuta for a cash consideration of 1340 million. So already, Yvonne, we are able to see that if you check in the question, on the first of the financial statement or statement of financial position, the balance sheet, the investment is 1540. So meaning there's a surplus of 200, whose investment has to be traced somewhere, obviously not to the subsidiary. It could be coming from the associates or the joint ventures.
Okay.
So in the exam, the first thing that you do, you first check on the what was the consideration. Then once you find the consideration, you go back there, check under investment. So the difference will tell you something. In this case, we are actually told there was a surplus, 200 million kwacha that has to be found. At 1st January 2018, the identifiable net assets of Tukuta had a fair value of 1850 million and retained earnings of 450 million. So we are actually told that at the date of acquisition, this is the value of the net assets, meaning that this is the number or a figure that we're going to use in the computations of goodwill. So we know that this is so much that it was, but how do we calculate goodwill? We know how much we spent as a parent company. We spent 1340. Then we add for the NCI, and less than 1850, then we'll be in a position to know our goodwill. Then we're told and retained earnings were 450 million. Why do we need to know this? It's very important because then at report date, whatever value that we are going to be given, less at acquisition in terms of the retained earnings, the difference is post-retained earnings, which then now is actually going to be taken to group retained earnings.
Okay.
The excess in value is due to an item of property, plant, and equipment that has a remaining useful life of 10 years.
Okay.
So the moment we're actually told this property, plant, and equipment, if it was land, then we will not be obliged to
the excess will be land.
To compute depreciation, isn't it? We will not. But because it's proper plant and equipment that have been given the economic useful life, so it's prudent, or it's our responsibility to compute a depreciation. So every note in the exam question, has a bearing on how you treat it. It is the group policy to measure the non-controlling interest at acquisition as a proportionate share of the fair value of the subsidiary's net assets. We cannot go against the policy. If the policy was dictating to us that we have to use fair value, then we have no option, we'll use fair value. But in this case, we've been told we actually need to use proportionate share of fair value. Then what does it mean? What it means that at acquisition, the value that we get at acquisition times the share of the non-controlling interest, that is a proportionate share. Similarly, if we are looking at post-acquired and we want to calculate the NCI that is only attributable to post-acquisition activities, we will also need to do that. And that's a policy. We cannot go against the company policy. We can only advise, but if they stick to it, we cannot go against it. On 1st July 2019, Cambodia acquired 25% of the equity interest of Ben for a cash consideration of 200 million. Then now it starts tying up with the 1540 that we saw in the balance sheet. Ben's profits for the year were 80 million. We'll just have to change these dollars.
Oh,
watch out.
yeah.
And do this. Yeah. So we are told on 1st July 2019, Cambodia acquired 25% of the equity interest of Ben for a cash consideration of 200 million kwacha. Ben's profits for the year were 80 million kwacha, out of which a dividend of 20 million was declared on the 1st December 2019. So this is also another interesting scenario, Yvonne. The first half of the year, Cambodia was not part of the company, was not part of the partnership or business partnership, I'd call it like that, as that. Wasn't there. So cannot claim the profits before he got some stake or before this company got some stake in Ben. So even the dividends that were declared to the shareholders of 20 million, what can be attributable, that which we can compute for Cambodia, will only be half of that. And once we compute half of that, then we'll get Cambodia's share, which is just 25%. So this component just teaches us on how to account for equity interest for associates using equity accounting. So we can start. So working one, what is on working one? You should know what is on working one. What is on working one? Yvonne. What is on working one? We want to establish
shareholdings.
Yes,
Share.
that is what we want. And you master these stages. At most, they can only go to 6 stages, at most. Maybe 7, maybe, I don't know.
Okay.
So here then, we know that if we are looking at this, so we know that we have the parent company here. We have the subsidiary. So what is happening is that which is what percentage? 70%.
70%.
Then again, this parent company
Acquired in Ben.
Acquired Ben. So acquired Ben, in this case, this is basically the associate of 25%.
25%.
So done, it's just a half mark. Don't even mind it, but it's half a mark. But you can find yourself for 9.5. Then you.
Yeah.
So here then, what is working to? Master it. Associates in the subsidiary. You need to master these workings. Net assets, net assets.
Assets.
In this case, it is in who? In Tokuta. So the phases, there are 3 phases of this. It is now we are actually looking at report date. So at report date, from report date, we are actually looking at the point at which we acquired. Actually, we are saying at acquisition, from at acquisition, you go to your report date, but you have to arrange it in such a way that we are saying what we are seeing in here is the report date. It's now. Then we now look at acquisition. Then we also look at post-acquisition. So at acquisition, what we do, we just go to the income statement and pick as is. We go to the balance sheet, sorry.
Yes.
We go and pick them as is. We don't need to memorize that component. So we have the equity shares.
The share capital.
So I can just uproot them here. So we have share capital. I'll come here. Pick it like that, which is in, and acquisition. I'll come to retained earnings. Then now we are actually told, that retained earnings at acquisition was how much? At acquisition, it was 450.
150.
Then we are actually told the totals. The totals at acquisition for the identifiable net assets was how much? The identifiable net assets of Tukuta had a fair value of 1850. So we have 1850.
Okay.
Oh, here, sorry, I have to add. So now, what are we taught about the excess? How is it the excess coming in? What's the story? We'll have to find the excess story, because ideally it should have been 1,450, but we have 850, which is basically we need to find this. We need to find this minus some of that. We need to find this. What is the story? Was it a proper plant and equipment?
Yes.
It was proper plant and equipment. So meaning that this is what was coming here. But because at acquisition, this was a 400 as proper plant and equipment, meaning that at report date, which is now, this is going to be subjected. It is going to be subjected to what? To depreciation. To depreciation. So we need to calculate depreciation for this. So we'll have to go back to the question and check. So how much? I'm giving you just about a minute to calculate depreciation for me.
The excess fair value of equipment.
How much?
5,100. 40.
40.
It's 40.
Is it?
Excess the fair value of the value of equipment 10 years.
Have you calculated?
It's 40.
Okay, so let's look at this. When did we acquire?
Oh, okay. Property, plant and equipment 1540. Okay.
How much?
500.
Is it 40? Is it 20? Is it 10? Is it 5?
It's 14.
14.
40.
So now this is what we first need to understand. We have to come up with a timeline. Timelines are very, very important.
Okay.
On 1st January 2018, we had the acquisition.
Of 1540.
So here it was, would say, the year of 1540. I just want to come up with a chart
1540.
that is going to help you nicely. But even when I do that, I'll do this. Then you have, that is at acquisition. Then at report date, what is there at report date? So at report date, the identifiable assets. And under this. So I do a timeline. So if you look at this, how many years? First, we know that the annual depreciation, if I do like this, I say from 1st January to 31st December 2018. I'll say 31st December. Here, by 31st December 2018, how much will be the depreciation, Yvonne? Definitely, or most certainly, you calculated it well to be that divided by 10 years, which gives you 40. But this only takes you up to 1st December 2018. You can even do like this. But then, you want to go up to 31st December 2019.
2019.
So in 31st December 2019, it will also be 40 by 10. But the cumulative depreciation would be to be 80.
For 2 years.
For 2 years. Because how did you calculate? Because you calculated the 40. The 40 only goes up to 31st December 2018.
December 2018.
But the balance sheet is showing 31st December 2019. So meaning that there were 2 years that need to be accounted for.
There were 2 years. Mm-hmm.
Which should now come in here as that. Agreed?
Yes.
So post-acquisition is basically that minus 1850. Come on now. So then now we go to working 3.
Okay.
So under working 3, what do you look at? Under working 3, what is your area of interest?
Goodwill.
Basically, goodwill.
So that.
Mm-hmm. Continue.
No, it's okay.
Mm-hmm. It's okay, huh?
Yeah, because I was thinking depreciation will be working 3.
No. So then goodwill. You need to maintain this fixed so that you don't mix. You don't get mixed up. You don't get confused with the workings. These are the traditional workings, so they have their traditional numbers that need to stick with you. Otherwise, you will get confused. So you need to just know that working 3 is goodwill. It is not ever going to change. Mm-hmm.
Oh, okay.
So under goodwill, all you're actually looking at how much you have purchased the business, plus what you think is attributable to the NCI, either using the policy or going by the proportionate of net assets. So you add that figure or those two numbers, less the net assets, the identifiable net assets, which you have been given in the question. So whatever you get, that then becomes goodwill. It's full goodwill in the sense that it also covers a component of the NCI.
Okay.
So we start with cash consideration. How much?
Cash consideration.
How much was cash consideration? How much is cash consideration?
Just a minute. I just enlarged them.
Or 1340.
Cash consideration.
Okay. Then we bring in the NCI. This is at acquisition. Never make a mistake because you are actually trying to calculate goodwill at acquisition. So at acquisition, we know that we have a 25% up there. So at acquisition, it is your total identifiable net assets times the 25%. So from there, then you come to the net assets. Oh, the net assets, the subsidiaries is not 25%. 25% is for the associates. It's
supposed to be 30.
30%. So I'll get in there and do that. Then now you have the net assets. Identifiable net assets, which you get from working to, can do like that. You get from here. Though I don't like putting negatives, like that. I don't just like it. I'd rather say less net assets. So goodwill will be that minus this.
45.
There we got to working for. So working for is the NCI. So you look at acquisition. And posting. So here you go at acquisition, you just pick the one that you have already calculated from Goodwill working 3. Then you go to at post acquisition, which will be certainly there the 270 times 1 minus the 70%.
So 70 times 70%, it gives you 81.
Yes, times, no, not 70%. Remember, this is the NCI. It's 30%.
Okay.
It's 30%.
30%. Okay, yeah. Okay.
So you got working 5, but we know that working 5 is also going to have some components from working 6 because there is some dividends that are coming from that are being received from Ben, meaning that we also need to look at the equity investments on associates. So I know there's a component that will come from working 6 because of those dividends. But here we'll say group retained earnings. So on group retained earnings, we'll start with the parent company, which is O.
Yeah.
So the parent company will go in here and pick that amount. From the parent company, we'll look at the subsidiary, but our interest will be post-acquisition, isn't it? So it will be the 270 up there, less the NCI at post-acquisition, Or if you want, you can say the 270 times 70%, you still get the same amount. Then from here, we know that when those dividends were actually given from Ben, first we'll also need to calculate the P's share of the associates' profits. That is what we need to calculate, which will definitely come from working 6. From working 6. So when we go to this question here, it shows how much profits were there. On 1st July 2019, Kambili acquired 25% of the equity interest of Ben for a cash consideration of 200 million. Ben's profits for the year were 80 million. But remember that what will be regarded as post-acquisition from the associates, which should actually be taken to Kambili's books, would be for the last half of the year. The last half of the year will give you 40, but then to be 40 times 25, how much do we get? So what we'll do is that here, as just a sub-working of working whatever, what I'm saying is that you have from Ben's is 80, that is full year. But then at post-acquisition, profits will be this 80 divided by 2, right? Because it's just the last half of the year. Then now the profits attributable to Kambili will be this 40 times the 25%. Yvonne, is it all right?
Yeah, I'm getting you. Yeah.
Getting me and getting it right, they are two different things.
I'm just seeing what you're doing first.
So this is the profit, right? So this profit is going to group retained earnings because Kambili invested in this particular associate or partnership in that business, Ben's business, and Kambili is getting a 10 million kwacha from there, right? But then we are told again in the question that those some dividends that were given, the 25% holding gives Kambili the power to participate, to participate in operating and financing decisions, and this is where we have realized that this is basically associates. But we are told out of which a dividend of 20 million was cleared on the 1st December. So we'll still do some sub-computations here just to understand what is at stake. So we know that we have Ben's dividend declaration, don't mind the spelling. So declared 20. But this 20, we need to actually, we know that this is full year. All we are interested in is the post what would call post-acquired dividends. I don't know if I can call that, but I'll say dividend half year, because that is when now we started managing after we acquired this business. So which gives you how much? Which gives you, okay, you have, they declared that 20, sorry. So meaning that this dividend attributable to, because here we cannot do the proportionate, like whatever, attributable to Kambwile would be this dividend times the Kambwile's share, because they have just declared, times Kambwile's share of 5%, which is 5. So meaning that in the group retained earnings, these dividends will be actually removed, because first the profits has been given, then from that profit we're actually subtracting the dividends. So here we'll say less dividend which is cos minus 5. So meaning that the total amount for the group retained earnings will be 644. That will be the total amount. Then here, actually I can do this so that I show that this is basically working 6.
Okay.
So then now we go to investment in associates. Investment in associates, which is basically investment in Ben. So I'll start with the cost of investment. How much was the cost of investment? How much was cost of investment? It was 200 million. It's here. It was 200 million there.
Yeah.
So we bring in the 200 million cost of investment. Then the post-acquired profits. Which we had already computed. The post-acquired profits is 10. Then less dividends. Five, because this goes into the balance sheet. Remember, it goes into the balance sheet. So, meaning that investment, what remains in the investments will be will be 215.
Okay.
So having done these calculations, I would want you to now plug in the numbers in the balance sheet. I want it to balance. I'll give you about 5 minutes.
I want you to balance.
It just needs to balance. What's my recording? Recording. So we now look at the statement of profit, loss, and other comprehensive income.
Okay.
So Just a real life example. Your husband net worth, say, is 5,000 kwacha. And your net worth, Patricia, is 2,500 kwacha. Then your husband borrows a 50 kwacha from you. How much would be the worth of your family? Is it your Njovu family? How much would it be?
It will be 7.5 still.
It will be 7.5. Thank you so much. Thank you, thank you, thank you. That 50 kwacha is just an intra transaction. Yeah. But because you are regarded as one, whatever happens as intras, we cancel them. That is real life. And these are the same concepts that have been borrowed when you're actually looking at group transactions, intra-group transactions. So you look at this table, it shows goods come into the group at cost of 10 kwacha or $10 each. Company A sells the same goods for 15 kwacha each to company B. But then company B obviously buys for 15 kwacha from company A and then sells to the outside world at 20 kwacha. Here, then what it means that company A could have or has already recorded a profit.
Okay.
Which is basically unrealized if B doesn't sell these goods to the outside world. So all we are actually saying, because it is an intra-transaction, we first need to cancel it. So that 15 kwacha or $15 that company A sold to company B has to be canceled from the group sales account. So meaning that sales will reduce by 15 kwacha. But in a similar manner, even when the B purchased those 15 kwacha goods, B has to cancel them. So you are actually debiting group sales and crediting purchases. In short, you are just canceling the group transactions. So if you look at this real life example at your home, what it means that your husband owes you 50 kwacha and you are owed 50 kwacha by your husband. So we need to cancel those. We need to clip them. We need to just cancel, to delete them. And this is what we are doing here. The income statement, when you're dealing with group income statement or statement of comprehensive income or profit and loss and other comprehensive income, it's very basic. That's by following the rules that are supposed to be followed under group transactions. So if you check for the parent company to be O, for the subsidiary, why we have put X divided by 12, we are only considering those months after acquisition. After acquisition, those are the months you are considering. So whatever numbers that you had in the income statement, you only get a proportionate of that based on the post-acquisition months. So that is what happens. But the adjustments here if you check on the adjustments, you have 3 adjustments on the top line. You have 1, the adjustment on your intra-sales. If any intra-sales, you will remove. You also, under cost of sales, you remove any of that intra thing, purchases. But remember that in your gross profit, you had overstated your gross profit by 1, first your inventory, by your provision for analyzed profit. So that has to be adjusted. If there's any adjustment on the depreciation, that also you have to adjust. So those are the only adjustments that you make on top. Then now, when you go down, you have the parent, which is basically the balancing figure. So you have your total comprehensive income that you add, then your NCI, which is basically a percentage of your total comprehensive income, or of your subsidiary, the part that is on the subsidiaries. So just that NCI. By the parent company, with the balance that goes to the parent company will be a balancing figure. So let's do it together.
Okay.
So we have the financials, or the profit and loss for Kawamba and Muninda. And we're told the following information is relevant in the preparation of the group financial statements. On 1st July 2017, Kawamba acquired 80% of the equity shares of Muninda, a public limited company, for a cash consideration of 90 million. The fair value of the identifiable net assets acquired was 85 million, and the fair value of the non-controlling interest was 25 million. So whenever you see such information, they want you to calculate the impairment, goodwill impairment, because this is an income statement, so you don't expect that information to be there. But if it is there, then they want you to calculate the goodwill, then you impair it, because it's that impairment that you take in the income statement.
Okay.
On 1st January 2017, Kawamba acquired 25% of the equity shares of Catalina, which now they associate, and exerted significant influence through its representation on the board of directors. Not significant control, but significant influence, meaning that it is an associate. Catalina's profits for the year were 100 million kwacha. It is the group policy to measure the non-controlling interest at acquisition at fair value. Goodwill has been impaired, tested, or goodwill has been subjected to impairment testing at year end and found to have fallen in value by 20% in Kawamba. So it justifies the first part, which you need to compute your goodwill, because then you can impair it. And an impairment is actually an income statement entry. Kawamba sold goods to Muninda for 20 million at fair value. So we know that we have to remove this intra-sale. Kawamba made a loss on the transaction of 5 million, and none of the goods sold had been sold outside of the group by year end. Interesting. Instead of a profit, there was a loss, so you cannot share a loss. So even when you're doing your computations in your income statement consolidation, as long as there's a loss, you ignore it. It's an intra-sale anyway, it's an intra-transaction. Muninda revalued this land and buildings at the year end and recorded a revaluation surplus of 50 million through other comprehensive income. Interesting. No dividends were declared by any company during the year. Assume that the profits accrue evenly during the year. Prepare a consolidated statement of profit or loss for the Kawamba Group for the year ended 31st December 2017. So let's go to Excel. So here will show the P, the S. If there are any adjustments, we'll have to put the adjustments here. Then we show the group now. So let's first put in the numbers. Gross profit, distribution cost, distribution cost. I'm working here. Admin, we have, just check. There's admin, profit before interest, whatever. So, okay, let's start first. We go stage by stage. Revenue for the parent company, how much was it? 1645. For the subsidiary, 480. Cost of sales, $405. This side, how much? 495. Are you even there?
Yeah, I'm there.
Then gross profit then. We have minus 100. Admin, we have 90. We have minus 35. We have minus 25. We need to calculate impairment, if any. Finance costs. We need to calculate any associates profits. Obviously, we have profit before tax. So profit before tax, then we'll go to taxation. From taxation, we'll actually look at profit for the year. Profit for the year. And if there are any revaluation, we'll have revaluation here. On the revaluation, showing is it 115. Oh, they are positives. 150. Okay, are you there?
Yes, sir.
Okay. So we first start now making some adjustments because that is very important. But before we make some adjustments, I'm going to give you about 2 minutes. Please calculate goodwill for me.
Hello, yes, sir. Hello?
Hello? Sorry, I muted.
Okay. I'm failing to minimize the shared screen so that I can open other pages.
Yeah, you're failing. Press on escape.
Yeah, that's just an escape. Okay, I want to open the question.
Have you managed?
Yeah, I have now. Let me open the question.
Okay. So it says, on 1st January 2017, Kamba acquired 80% of the equity shares of Ninda, a public company, for cash consideration of 90. So put the 90 somewhere. The fair value of the identifiable net assets acquired was 85 million. And the fair value of the non-controlling interest was 25. So it's 25 plus 90. That's what it is. 25 plus 90, because you have cash consideration of 90 plus 25 NCI. How much does it give you? It gives you 925. 925 minus the identifiable net assets at acquisition. It cannot give you 10. It's not possible. Yvonne. Hello? Hello, 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 hello. Are you there? On Goodwill, I'm saying, yeah, I'm saying on Goodwill, it's not, how did you compute Goodwill? Let me know how you got your 10.
Cash consideration at 90.
Mm-hmm.
Hello?
Yeah, hello, I'm getting you.
And then on the NCI.
Mm-hmm.
Hello?
Hello, I'm getting you on the NCI.
NCI is the fair value of the non-controlling interest was 25 million.
Mm-hmm.
So 25 million by 20%.
No. It can't be 25 million by 20%. Why are you subjecting your NCI to 20%? Because it has already been given for the NCI.
Okay.
Why? First, let me know, why are you subjecting it to 25% to 20% computation?
The parent acquired 80%.
The parent acquired 80%. Yes.
Yes.
Uh-huh.
So the NCI, it means it's supposed to be 20%, right?
20% of what? Here, you have already been told the policy is to use the fair value. If you are not using the fair value, you could have said 20% of 85 million, which is the net assets, identifiable net assets.
Yeah. Oh, okay.
But then now you are already, someone computed for the NCI and gave you 25. So you cannot subject 25 again to a 20%.
Okay.
Mm-hmm. So how much is the goodwill? Hmm?
35.
35. How?
Why are we missing each other?
Check. You have your cash consideration of 90. So it's 90 plus 25.
90 plus 25, it's giving me 90 plus 25.
It's giving
it is
105.
Huh? Not 115.
Yeah, 115. 115 minus the net assets.
85.
How much do you get?
30.
Yeah. So how are you getting the 35?
No, it's supposed to be.
So it's 30. Now
yeah,
that,
it's 30. Yeah.
Now that 30, there was an impairment of how much? of 20%. So what is that impairment? How much is the impairment?
The impairment is 5 million.
How?
Kawimba made the loss on transaction of 5 million.
No. We are looking at goodwill impairment.
Oh, okay. Oh, it had fallen in value of 20%. So impairment will be 6.
To be 6. So now let's do the computations. Let's now go back to Excel and finalize this thing. And you can go to church.
Okay.
So the first thing that we do, we know that revenue, there was an intra. We have to remove that intra sale of 20. So say minus 20. Here on cost of sales as well, we have to remove the 20. Well, I've put the positive there because they are negative down there.
Oh, okay.
So that is our first adjustment. So now we go to other adjustments. It's on impairment. On impairment, we have added a 6, which was impaired, isn't it, on goodwill?
Yes.
So you put minus 6 there, meaning that is what was actually impaired. But then, this impairment, in short, it just goes and fits under admin or actually basically under admin. That is why your impairment would be so that you have your 121, but just leave it like that. It's so that we show the impairment where it's supposed to be. Then now we have the associates. How much profit was made on the associates, which we have to adjust in the group. There was a profit made of 100. If you check on your notes, there was a profit made of 100. So we are saying 0.25 times 100 million, which is your associates profit, which is 25. So here then now, profit before tax would be how much would be profit before tax? Sorry, would be this minus sum of that. I don't know why I'm missing it. This, sorry. Okay, so these numbers here, we are actually getting only for post-acquisition. I just made a mistake. We're getting for post-acquisition, which is the last half of the year. So which is 6 divided by 12. So we're just getting the last half of the year. I'll do like this, 6 divided by 12. So the last half of the year would be this divided by 2 and just type 2 here. Okay. This amount divided by 2. How much was the cost of sales? Maybe I'm now even getting confused from the question. How much was the cost of sales? Oh, it was cost of sales was 900. So it's 990 divided by 2, which is 495. That is not a problem. Okay, these others, I think I divided them.
I think the rest are okay.
So this comes in as a negative. Okay. So meaning that now from here, this is where we do this. How much is profit before tax? Saying this minus instead of saying minus, I think this is why I'm making a mistake. I know, but we're supposed to subtract. So it's these numbers here. So you have a 284 as profit before tax. I hope that is what you have as well. Then taxation, we have a 49. So profit for the year, again here, I'll do like this. Then here, I'll do like this as well. Would be sum of that to 235. Then we have revaluation. You know, revaluation, you don't divide it by whatever in terms of the years. So revaluation in your total is valued by 100. You don't do like from up there, we've been dividing by 2. You leave it as is.
Yes.
Because the revaluation is as that.
Oh, okay.
This is why we haven't divided that. Okay. Then we are told. So when we add this, how much do we get? So we have a 385. This is when our mathematics begins. So the 385, we need to, from this 385, there is a component for the NCI, right?
Okay.
So there's a component for the NCI. So I'll leave some space for the parent company, which we don't know. For the parent company, it is going to be a balancing figure.
Okay.
But then we have for the NCI. So for the NCI, I'll come here. We'll need to find the percentage for the NCI from here. For the total, if I done, let me take them down. So when you come here, you check how much do we have if we're to look for the total. So if you check, you'll find that for the NCI, for the CI, that is the total comprehensive income, you have your 385, but for the subsidiary, you have 100. So what we are actually saying is that for the NCI, it is actually going to be this 100 times 20%, which gives you NCI, which gives you 20. So meaning that for the parent company, we are going to have the 385 minus the NCI. So whatever remains goes to the parent company as a balancing figure, which is 5. That's all.
So, the NCI 20?
Yes. And you know this 20 is coming from where? It's coming from here.
Oh, okay.
Because the NCI has no share in the parent company's holdings.
Oh, I see.
So only in the subsidiary, because this is where the NCI has also invested.
Okay.
So getting a 20 there. Are you done?
Yes, sir.
So tomorrow, I know Mondays are a bit difficult, but I'll try to find time on Monday, maybe by 18 or so that we go into group complex.
Okay.
So now, yeah, it's now getting hard. So you also need to get hard.
Yeah.
Okay, thank you so much, and bye-bye.
Thank you, sir.